long do you expect the pause to last?
Well,
I mean, surely...
I'm saying I think the pause is going to be longer than
Yeah.
what the market is priced in for now, for sure.
And so we have to wait till, what,
we could
2024
we could easily
deep into
be
it?
into next year. We could easily be into next year before we really see that. Yeah.
What do you think, David, about the earnings picture? We had everyone comes on the program and says, "Hey, first quarter earnings weren't bad, but they weren't great, you know." And we're not expecting them to be fantastic in Q2 either. And then we get into the second half where that's where people have their recession forecasts, right? So what do you expect from American companies?
So we would say that the earnings outlook will begin to gradually come down. You always see the expectation game being set now, even with the earnings that came in, which maybe were fine-ish, and for some companies maybe better than expected. Even for those companies, they were managing expectations for the rest of this year. So if you read through the transcripts, what you will see is a more hawkish tone than what the actual numbers were earlier. And I think that gives you a good indication of where people are kind of expecting that to trend for sure.
What do you think about, well, I have a question on sort of average Americans, if there is such a thing. Number one, on the average consumer, how much money does he or she have left? And number two, I wonder about the retail investor, because Bank of America came out with a survey showing that for 10 weeks in a row, they're pulling out of this market.
Well, I think that the thing to remember the most is that they've got almost more than $1 trillion more in savings than they did pre-pandemic.
Actually, I'm going to cut you off there, and it's a great time to cut you off, because $1 trillion in savings. We have to go right now to Brian Moynihan, the CEO of Bank of America.
Well, ask him about that.
And we'll ask him about that. David Weston is talking to him right now at our Bloomberg Invest conference. Let's listen in.
Government coffers were drawn down pretty substantially as they came right up to that so-called X date. And now they've got to issue a lot of T-bills. I saw one estimate like 850 million by the end of the summer.
Billion. We wish it were a million.
Oh, billion, 850 billion, and maybe $1 trillion by the end of the year is what I saw. The speculation is that might draw liquidity out of the marketplace. Are you seeing that at Bank of America yet?
Yeah, it's too strong, because I think if you look, they've daily published their balances, and they moved up a chunk, and you guys covered this today, and because of tax payments coming in, and you get estimated tax payments, et cetera. But their policy has been, by their own design, to get to have $1 trillion of money running through this that they have at all given times, so they fund to keep it level there. So they're going to have to push up and do that kind of funding level. You know, when I ask people, is this disruptive or not, all the experts tell me it took deposits out of the banking system. But, you know, I'm not sure people see that as a big issue. And by the way, the Treasury Secretary, and I think they said today, they will do this on a non-disruptive basis, because they just ran down to $39 billion. We're still able to pay the bills. So they don't need to get there tomorrow, and they'll build it up over time. But their goal is to get back in a more regular way. The best news about this whole dialogue is they've got an agreement that extends a period of time, so we shouldn't have to deal with this for a while, which is really critical, because the United States has to be the beacon of stability, strength in the world. And at times when this discussion's going on and you travel the world, everybody gets fixated on it, because the United States is the benchmark of benchmarks. And if it goes kapooey somehow accidentally, it's a real problem. And so they would get all fixated and all this sort of activity into planning for it and what would happen in all our company. It would just be better if it didn't go on. But it's a political process, and they had it. Well,
beacon of stability, we didn't look much like that for a little while there, right? Do people forget about that after it's over, or are there lingering effects, do you think?
Well, I think that, look, in my memory, in 2011, it felt more serious at the time than it did this time, because I think people had learned from the actual shutdown and some of the dynamics in the actual downgrade of the United States that you can't get that close. So I think the assurances of both political parties plus the experts involved always was, we're not going to let this. It may be messy. It's like a Greek tragedy. You always know what the end's going to be, but it's fun to see how they get there. But, at the end of the day, they got there, and that's the important thing. But it's a political process. There's another serious question about how much debt the country can afford and all that stuff. None of that's embedded in this as much as it is, the issue of the moment was really getting the idea that somehow they would not be able to pay their bills or have to shut down and or default off the table, and that was done.
Perhaps a related issue, actually, are the reserves required of your bank and other banks. There are reports, and I don't think it's unexpected to anybody, that there's going to be an increase in capital requirements. If that goes forward, will it have any effect on your ability to make loans?
Yeah, so there are multiple discussions which get sort of pushed together. There's the standards for the finalization of Basel, which is this broad set of things. That's going on. The stress test is going on that we forget about, but that's going on also, and that resulted in some surprises in the industry in terms of capital demands last year. And then there's the question of applying standards that apply to the GSIB banks, the biggest banks broader in the platform because of the size of some of the banks. And so all three of those things get mixed together a little bit. But at the end of the day, it's a fairly straightforward. If our capital ratios go up by 100 basis points, we basically, simply put, you can't make about $150 billion of loans. And because people say, well, you have more capital, you can make more loans. But if we took risk on that capital, we wouldn't have that capital ratio. So it has to be a riskless build of capital. Can't be out there taking risk. So the only thing you can really do is leave it in cash or buy treasury securities. And that's not a very productive use of money. So, and if you had it, and that's the problem. And so every time capital goes up, there's a countervailing effect to it. It impacts lending.
Is that a gating function here right now? Over the last couple of weeks, you've been saying that, in fact, some of your lending is slowing down anyway, just because the economy is slowing down. Is there demand enough for the loans that you can't make?
That ebbs and flows all the time. So the loan demand is more a product of customer activity. And so our team has a recession predicted beginning in the third quarter, fourth quarter, first quarter. Bank of America research team, which Candace Browning-Platt leads, is tremendous, and they have that. That has moved out a little bit as a consumer, and activity stayed stronger, even in light of the fastest Fed rate increase in a long time. And so, but it's still the prediction. And so I think companies are having gone through the inflation and then it sort of flattening out and thinking about the future, just being more careful because they realize that some are able to move prices, some are able to do it. They're getting relief on the commodity side, on the price side, but are they going to be able to hold price demands as final demand in the construction industry will be as strong a year from now as it is today, and the housing, all this is on people's minds, so they tend to pull in. And so that means line usage is flattened back out. So line usage was here before the pandemic and then fell and moved up, and it was kind of moving up incrementally back to where the pandemic sort of flattened out for the last couple of months, which means that companies are just being a little more careful.
So I see actually a survey was done in this room of the likelihood of recession in Q1 of 2024, and it looks like, what is that, 65% of the people agree with your research. Isn't that good to know? You've got a ratification there.
Yeah, one thing we always have to be careful. Somebody educated me once that the forward projection of recession by economists is always like 15 or 20%. So anything above that means that they're convinced. So we'll see.
So let's talk about something that's very much in the news these days. That's artificial intelligence, particularly generative artificial intelligence, large language model. You and I have talked in the past about Erica, which is a form of, I think, machine learning you've been using for some years now, 5 years. We've never really talked about what that is. So take us through what Erica is for Bank of America right now, and then we can talk about where it's going.
So what Erica is a product, a capability that's in the mobile banking app and other that you can go into and either type in or say, pay my landscaper, pay my school tuition, whatever it is, and it will then say pay, and it'll say the name of the provider, how much you want to pay, and then it'll go pay it. It'll just run through the bill payment system. So instead of going to bill payment, going down the list and doing all that stuff, it do it. Or what's the routing number? What's my routing number? Because that's a topic that people call us and ask us about 5 million times a year. They used to call us. Now they don't have to. The routing number is on the base of your check, and routing number for all of you is the same. So it's not. But people call because, frankly, judging by the age of the people laughing, we were taught somewhere how to write a check and how the numbers worked and what was your account number. That's no longer in the system. So when somebody's doing ACH and stuff. So really like 7 or 8 years ago, we said, let's build something that can do that kind of language processing, the LP part of the thing, and then predict what the question was, use our data and our information, and then come back with the answer to them. And so we started to do that, and the first thing we realized is the language that was out there for these natural language recognition type things was not written for banking. So what's my balance? Do you want to go to a yoga class? Think about it. So the first thing I had to do is we went to outside and got them to write a banking language program and things. And then we had to pair it with our data and our information. And so that's now 5 years old. And 20 million people use it, and they use it 150, 200 million times. We're just ready to cross 1 billion interactions with it. We'll get another billion in another 12 to 18 months. It's growing that fast. And it just saves a lot of time for the customer and client. And the experience is great. And yet people, I think, will start using even more now because they're playing around with ChatGPT and doing other things that this was sort of foreign to them. They were, what is Erica, like you asked. But what we've seen is it just continues to grow. And 20% interactions year over year, 30%, it just people going, because people like it, use it more and more and more. And it can answer queries. Now, the flip side of this is why have we deployed it when you hear all the worries you have about it? This is our data, this is our processing, this is our predictive language, artificial intelligence tool, the virtual assistant, feeding off of our Q&As and questions that we've edited to make sure they're right. So we don't have the problems that we're dealing with everybody's data and everybody's answers and everybody trying to figure out what is it perfectly going to apply. And so that controlled environment isn't the environment that these wonderful things are running on. At some point, they'll come together. In other words, why do we have a proprietary one when you can use it? But in between then is the ability to make sure your data doesn't get pulled into places that shouldn't be, making sure it works appropriately on your systems. And you're reading the articles in New York Times today and stuff, about in the healthcare industry, there's something written up and all this, all these pluses and minuses, the legal case everybody's written about and all this stuff. Those are the risks. And even the people who really know this, tell you, this is 3 to 5 years of work to get those vagaries build a system. But we see it today. Now, you took that same stuff and you went and applied it to analyze who the best customers to call based on our data by people making inquiries to it for prospects in our business banking. And it was called Banker Assist, and that is out there operating every day. So a person has 100 prospects are looking at it in that line of business, and they can't call 100 all at once. So it tells them the best 10 based on who they cover, what they do, the kinds of industries they cover, the activity in the industry. Look, and these are 50 million under revenue companies. So this is not huge companies and doing searches of the outside environment and talking about it. So we use it in other places already. It's got high potential. We got to make sure we maintain the appropriate customer experience, the appropriate control element around it to make it work.
We'll talk about the control specifically, because one way to expand it is just get more usage of it, which you're doing right now. Another way is to have it do more things. And we had a report actually on the Bloomberg this week about the CFPB, Consumer Financial Protection Bureau, coming out and warning banks, saying, watch this generative AI, banks, because it can make some mistakes. Yeah. How do you make sure that you can use it the right way and you don't go too far?
Right. So that's the constraint on the openness of it, for lack of a better term, and by constraining it to our data and our information and editing and looking at the answers it gives and constantly making sure. But that's easier when you're saying it's our customer base, our data, our systems, our information, and our transactions. I'm not trying to assess the whole, everything out there, and that's a whole different question. So, but that's the lesson learned. But that environment doesn't do a lot of good for society. It does a lot of good for Bank of America customers and Bank of America. The question to make it good for society, it's got to have all of it in there, and that's the bridge from here to there is that question. So, the simple answer is we monitor that. We build it proprietarily, so it was built around our. Effectively the same thing a human would have done if asked the question. And then, we convert that and then we back test it. You have to always look at it. We underwrite with automated and artificial intelligence and automated tools, but not in an open environment like this where the customer can keep at it. It's much more controlled as to how that works.
One of the hallmarks of your administration as CEO of Bank of America has been controlling costs. You've been very adamant about that and very diligent about it throughout. What levers do you have at this point? Is AI a lever to help control costs, do you think?
Yeah, it will be, and it will be another. I always think of these things in arcs, so what could you do now that will pay back over time and keep paying back? And so if you started out big fundamental things we made, before people knew what the cloud was, we built an internal cloud. What that did is took all the server environments which were inefficiently disposed of, and that's the theory of a cloud, and pushed them together and said, you may want green servers, but you're going to take the blue ones because your software operate on them because you had somebody deciding that green ones are better than blue ones. So we pushed that in, and then you went to the cloud. And then, so these arcs of movement are just, so then you went to the cloud with parts of your stuff, and the question is, what can you do more? And each of that pays you back over and over again. And so, but the first answer was to go from 30 data centers to 5 or 6, and then down to 2 or 3, and then you have to have a certain amount of it. And that saved us, $400 or $500 million of run rate expense a year, to give you a sense. I mean, those are big moves, and then now the public cloud and et cetera. If you think about it, So you have to think about all the costs that way. So in real estate, we had 120 odd million square feet of real estate. When the management team started in 2010, we're down to 60 to 65 or 70. And we still, with all the packing and stacking and work rules, even because of the pandemic, got to about 80%. So there was a lot of room to go. And now with all the work rules and stuff, you have a whole nother round to go. And so all that is, you just manage expenses by looking at all work that can go away and all inefficiency go away and how you apply technology. And then you got to get the customers use it. So 70% of people our age bracket and above use digital today. That number is growing, the fastest growing segment we have. It's not surprising that millennials and Gen Z and et cetera have a higher representation, but the reality is it's not getting everybody use it, it's also getting everybody use it fully. So even with younger people who use it a lot, still will deposit their checks at the branch. You know, that difference is $5, 50 cents and a nickel, depending on branch, hand it to a teller, put it in an ATM or do another thing. And so there's a migration, even with people you think are using it, we still have $250 million will go out of the ATMs by tomorrow this time. I mean, it's amazing. So how do you get usage? So it's all those techniques just applied. And will AI help that? Yes, because we have 14,000 call agents. We have, where AI we think is near-term helpful is in computer development, program development. And that open source coding and analyzing, you still have to test it, but you can get it written faster, make it simple for people, and that we think has great applications sooner rather than later.
When we talk about costs, what about headcount? I know you said that it's not so much you're laying off as you're just not hiring as many as you were a year ago.
This goes back to economic, and I even talked to customers. So last May we hired 3,000 people, excuse me. This May we hired 600, 700, and that's all because the turnover rate fell because last year we were in the middle of Great Resignation, and now it's completely different. So we went from 12% turnover in the company, which is sort of the long-term level we're at pre-pandemic, down to 6, up to 15, and now back down, getting close to 6. So we don't have to hire as many people, yet we keep managing the headcount down. We just had 2,500 wonderful interns start this week, so that'll make us about, by the time we cross the quarter end, about 215, but you take them out, we'll be 213, 213 and a half or something like that, down from 216, 217 at year end, and we peaked about 219,000, not 209.
More broadly, do you think the job market is a bit softer than what the Fed realizes? Because a lot of their numbers are backward looking.
Yeah, I think if you talk to employers today in the technology spaces, there's always specialized things like welders in certain businesses and high-end manufacturing help, explosion in the Midwest, just having been out there. But in general, it's much less tight than it was in the spot market. And that's why the crit rates going down and all that stuff, you see it in the amount of hires. And, so job postings are still high. I'm not sure CEOs that I talk to are pushing people to fill those as much as fill them when you have to. And that has a dampening effect on the labor market that won't show up in the aggregate numbers. Employment's still at 3.7% unemployment. It's still very strong. And so the big debate, if you want to drive your economists crazy, say, how can you have an unemployment-less recession? And, they can't quite get there. And that's kind of the interesting question. And so even the highest predictors of unemployment don't even get to 5%, which is hard to square.
One last one, another hallmark for you has been responsible growth for Bank of America. From the day you took over, that's what you said you were pursuing. And you've also been fairly explicit about ESG investing and how that fits. There's been some political turmoil about that in the country now, with some of the states now, including some affecting Bank of America. How do you put together your desire for responsible growth on the one hand with taking into account things like environmental and social and governance?
Well, as we look out, the oldest part of the company has been around for 230 years now. They're almost and pushing beyond that. And so, our industry is a product of the communities it operates in. So we make it pretty simple. When we think of who we have to do a great job for, we have to do a great job for our customers. We have to do a great job for our teammates because we have to be the best place for teammates to work so we have the talent. We have to do a great job for our shareholders. We just had record operating profits in the first quarter. And we have to do a great job for our communities because, frankly, a bank reflects the economy. And so if the communities aren't strong, we're not going to be strong. So that's how we run the company, and responsible growth really talks about that a little differently, but that's how we run the company. And it's the genius of the and, profits and purpose, not one or the other. And Jim Collins wrote about that in 1996 as the theory behind, there's the thought process behind it. That's all good stuff. And the answer is sort of, what's wrong with that? thinking about how do I do a great job for my customers? How do I do a great job for my team? How do I do a great job for our shareholders? How do we do a great job for our communities? And that's so. When you think about the energy and stuff, go out to North Dakota with Senator Kramer. We talked to the people. They got a net zero commitment at the state level and everything, and they got all this innovation to do carbon capture storage. Our job is to help lean into that and make that happen. Well, we have energy for everybody, and good, cheap energy for everybody, and energy for people in the global south that don't have as, these are interesting questions, but at the end of the day is private sector will drive this. And the money's there and the talent's there, and we got to drive it because in the end of the day, we can make it happen and have good growth and, frankly, from the United States perspective, dominate the place.
Brian, thank you so much. Always great to talk to you. Brian Moynihan. He's the chair and CEO of Bank of America.
All right, that was David Weston speaking with Bank of America's Brian Moynihan at the Bloomberg Invest Conference. We have an amazing conference here. I mean, the sixth floor at 731 Lex is absolutely packed. The most important people on Wall Street walking back and forth in front of our eyes here. And some amazing panels here. One of those panels, institutionalization of ETF ownership. I will be hosting that panel tomorrow with a number of guests, including J.J. Kinahan. He's Chief Executive Officer, IG North America. He's with us here out of Chicago. First of all, JJ, I'm sorry about the weather.
This is crazy. It's like walking in a horror movie, man.
I know, right?
And it will be an amazing panel because you're hosting it.
Yeah,
so
no, I'm really looking forward to it. And I also co-host ETF IQ with Katie Greifeld and Eric Balchunas. So I love this this spot, this piece of the investment universe. To me, ETFs are just such a fascinating wrapper and package that the growth is just unbelievable. I mean, we're at 10 or 11 trillion dollars now globally in ETF assets, and that number just continues to grow. What's your take on the future of ETFs? I mean, can we keep up this pace?
Well, the pace has been amazing. If you look what we saw from the retail and among our client base from January to November last year, the growth rate was absolutely astronomical. We've slowed since then, but I will tell you what's still amazing, man. In this time of, I'm going to say, uncertainty in the market, it's not a bad mood in the market, but it's not euphoric, even though we continue to rally, and you see that reflected in the VIX, that the ETF space is still one people feel more comfortable in. I think there's still a reluctance outside perhaps those 8 or 10 names in the NASDAQ that are maybe the great 8. Outside of that, I think you're seeing people with a reluctance to participate in the market, except perhaps through particularly the bigger names, the spiders, the QQQs, and to a lesser extent, IWM. So as a percentage of trades overall in the market, that's going to continue to stay high until people have the confidence and are ready to commit to the market overall. I don't see that happening for a little while.
Yeah, but the Qs, by the way, have been amazing. I mean, Eric Balchunas was comparing the Qs to growth fund managers over the last 5 years, 10 years, and 15 years, and the Qs outperformed everybody that there is. I'm always shocked that there's not like a FANGs ETF. Why isn't, this wonderful 8 group of companies grouped into one ETF?
I don't know. You'd have to ask the fund distributors and the smart people who put those together overall. I think maybe there's, I know there was talk of one, and I think there may have actually been a future on it at one point, but I'm not sure that it actually took off overall, so that may have been part of it. So, as we look at this, though, I think one of the things that's going to be really interesting to me, Matt, as I look out over the next 2 weeks, we come to the end of a quarter. To your point, you look at the Qs and how they've outperformed. I don't know that many fund managers have been as invested, so it's going to be really interesting to see if they go after these individual names, if they go after the Qs, if they go after both, to show a little bit of window dressing, or however you want to say it, at the end of this quarter. And with the major threats taken off as reflected by the VIX, I think the market's telling us that over the next short period, they don't see this bearishness. So I'm really interested to see how these next 2 weeks go.
It's funny, I remember learning about window dressing when I was a kid in this industry, when I first got into it, and I still always forget. And at the end of every month or every quarter, when we see some big moves, I'm reminded sometimes, and I'm like, wow, that really does happen, and it's really impactful. And that's a great point. You could see people load up on the Qs just so they look good to their clients. You mentioned, though, that we're in this period of low conviction, and it's true outside of the big mega cap stocks that have rallied. There's been no breath here, but we have gotten past the debt ceiling. It looks like we're getting to the end of the Fed hike cycle. Maybe it's going to take a couple more months. What do you think we need in order to, as a listener wrote in and asked earlier, when are you going to be able to put a stake in the ground and have conviction in your trades?
Well, I think that the fear of rate hikes is still going to continue through the July meeting. If we look at the meeting next week, you have I came in earlier, there was a 77% probability that we would stay put. To your point, the debt ceilings come off. As I said, you have end of quarter coming up. We have the July 4th holiday coming up. So if you look, what's really the catalyst? There's no earnings. Unless the Fed does something surprising, which I'm not actually completely discounting. The reason I say that is this. To me, the market's been like a spoiled child. We don't want rate hikes. We don't want rate hikes. Chairman Powell's been, we're going to continue to do it as we have to. We're going to continue. It's like he's the market's dad saying,
as someone with a toddler, I totally understand what you mean.
Exactly. Yeah. And so he's been saying, we're going to do this if we have to. I don't care if you listen or not. I'm going to do what it takes. So I think at times the market has perhaps discounted what they want ahead of what we're being told. So that to me is also going to be very interesting as we head forward. And one last thing I'll say, speaking on the ETF space, you're perhaps not seeing as much in the, XLF, et cetera, those types of ETFs that reflect the financials. And I think one of the things the market's looking for is what's the next sector to help us outside these stocks in the NASDAQ.
You have a guess?
I do think it will be the financials, and the reason I'm saying that is at some point I think this curve is going to normalize. It may take us longer than we think. It's already, in my opinion, taken longer than most people think. So what that tells me is it may be, to your viewer's question, it may be October before we're actually at that type of level where we can put a stake in the ground.
That's amazing. All right. Hey, it was really great to have you
Thanks for having
here,
me,
and I'm looking forward to the panel tomorrow.
As am I.
I think it's going to be right afternoon, right?
I think it's 12:30, if I'm not mistaken.
12:20, 12:30, right around there. So highly recommend that our listeners and our viewers tune in to see that. JJ Kinahan's going to join me with a number of others in talking about the ETF industry, which, as I say, has grown phenomenally. Last year was an amazing year for new ETFs. We haven't seen that much this year, maybe in this quarter. So maybe it's slowing down a little bit. But I think, among the ways that people who are growing up invest, ETF has to be the biggest and the biggest gainer there, because mutual funds are a thing of the past, and the conversions I think will continue. JJ, thanks so much for joining us. Pleasure having you here. JJ Kinahan, of course, is the Chief Executive Officer, IG North America. We'll continue to bring you guests from the Bloomberg Invest Conference here at 731 Lexington Avenue. It does look like a scene out of Blade Runner 2049 with all of this Canadian wildfire smoke drifting over New York City, but it's still a lot of fun. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:58 on Wall Street. We do check markets all day long here at Bloomberg. We've got just about 90 seconds to go until that closing bell clangs on Wall Street. We're looking at a mixed market right now. Looks like a down day for the S&P, NASDAQ, and the NASDAQ 100 index. A drop in tech shares drove equity indexes lower. Treasuries retreated after a surprise Bank of Canada rate increase fueled bets the Federal Reserve is not done with its own tightening. JJ Kinahan is CEO at IG North America. Moments ago right here on Bloomberg Business Week, he said you gotta listen to Fed Chair Jay Powell.
He's been saying, we're going to do this if we have to. I don't care if you listen or not. I'm going to do what it takes. So I think at times the market has perhaps discounted what they want ahead of what we're being told. So that to me is also going to be very interesting as we head forward.
And right now, the S&P down 14 points ahead of the close here. Drop there of just about 0.3%. Dow Industrials up 95, higher by 0.3%. NASDAQ Composite Index down 167 points for the NASDAQ Composite Index. That is a drop of 1.3%. NASDAQ 100 Index lower now by 1.7%. The Russell 2000, though, an up day. That index higher by 1.8%. Dow Transport's up today by 2.5%. Again, 10-year yield 3.78% with the 2-year yielding 4.55%. There it is, the closing bell at the New York Stock Exchange as we wrap up trading on this Wednesday, June 7th. It is a mixed Wednesday with the Dow as the numbers settle here up 92 points, up 0.3%. S&P at the close up by about 0.3%. NASDAQ down by 1.3%. Spot gold down 1.1% to $19.40 the ounce, while West Texas Intermediate crude oil up 1.2%, $72.63 for a barrel of WTI. Google is telling its East Coast staff to work at home because of smoke, that according to CNBC. Stitch Fix shares surged today as analysts noted that the online clothing company's better-than-expected revenue and cost-cutting measures could pave the way for better profitability. Stitch Fix shares rallied today by 28%. And Dave & Buster's shares soared after the food and entertainment venue operator reported first-quarter earnings that beat estimates. Shares today using the ticker symbol PLAY up by 18.3%. Recapping, S&P down 16, a drop there of 0.4%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Fantastic point of view. No one to tell us.
I have a Disney connection there, as well as the whole new world that is unfolding when it comes to the world of investing and finance. Welcome back, everybody. Bloomberg Business Week. Carol Massar, along with Matt Miller, back at Bloomberg Invest in New York City. But I'm live in Orlando at the BNY Mellon Pershing Insight Conference, and delighted to have back with us Ram Nagapan. He's Chief Information Officer at Pershing here in Orlando. We talk so much about strategy and the macro, but so much of what we talk about, I feel like at Pershing and at this event, is about the role of technology increasingly. Yes. So I'm curious, we're going to get into AI, we're going to talk crypto. It's been a big week for crypto, blockchain. What is it, though, that you spend the most amount of time on when it comes to technology related to the financial sector?
It's providing the best experience to our client and efficiency.
What does that mean, though?
Listen, when you interact with technology, it should be so seamless. It should be the best experience that you can ever have, and that's what we focus on. For example, I'll tell you, you do wealth management, you buy stocks, you use a website, right? The advisor provides you the website.
Right.
Here, we make that website to be created by the advisors themselves with few selections. Can you imagine that? You've used Shopify, right? How easy it is to put a store.
Right.
Imagine we bring wealth management websites so an advisor can put it up with few clicks. That's what we do. It's a no-code Gen AI solution. I know I use the AI, but here, it's a no-code solution. How do we empower an advisor to build these things themselves so easily that they can customize it? Just imagine.
So when you say no code, you basically give it to them.
Well,
what does it mean?
A no code means you just select few options, what you really need, and we can generate the whole website for you.
Right.
And imagine Carol Massar is going to have her own website. You are the family office for that advisor. You will be treated so special, completely personalized, and you have your own website. Imagine that instead of just using one big thing.
How many financial advisors, independent or others, I'm assuming the larger groups already have websites. How many, though, that don't already do that?
Most of them have, but it's one thing. There's only one website they have. So you and me, if I use the same advisor, it'll look the same.
Right.
But imagine you have different needs, I have different needs, and we need to personalize that. And that's the next step.
Well, and it's interesting in terms of the digitization of the financial world. It's also increasingly, we've talked about this before in years past, the personalization that's also going on, right? Increasingly, they want more and more of this.
Yep.
From the client's perspective, as well as the clients that you guys serve in terms of investment advisors.
Yeah, that's right. So when we talk about personalization, I just want to give you a little bit of a view.
Yeah,
See,
please.
let's say you there's like 100 functions the advisor provides, but you only use 5 things. We want to make sure that 5 things shows up for you. And what you really care, where you really want to invest, what are the news that you want to see, we want to personalize and present it to you. So this is the level of personalization.
So I'm curious, Ram, how many people here or leading up to this event or since the news of Microsoft and their $10 billion investment in ChatGPT, how many have all of a sudden been calling you guys and saying, all right, tell us about this. What do we need to know? What are you doing for us? Or what were you already doing?
Every one of them. It's in everybody's mind about this, and we are on top of it. See,
Is it real? Because, I'm thinking of Bloomberg Invest, where my co-host is back at New York headquarters for Bloomberg. David Siegel, Two Sigma co-chairman, co-founder, he said, the hype is absolutely remarkable. I've never seen anything quite like it. A guy who's been having an impact for 4 decades, and this stuff isn't brand new. Which is like, we keep, having these conversations saying AI's been around for a while, but this is something different.
yeah, it's not a hype. Some people say AI means you outsource your brain. That's not true. It augments your brain. If you use it right, you could do wonders in productivity and many other things. And that's what we're doing. So we're taking this technology. It has pluses and minuses, but due to the power of the compute, we can actually make things real now. You look.
What do you mean real?
Well, the chips that are available are so fast that we can actually do these models at that rate that you can actually consume. So we are certainly looking at AI in every part. It's going to be a general purpose technology like internet.
Really?
Yes.
Well, so Ram, help me out here, because again, we keep saying artificial intelligence been around for decades, right? You guys were already using it. What happened with the explosion of the news with Microsoft specifically? Was it because you're saying the chips were there, everything was there, they were having kind of breakthroughs, if you will, in terms of the utilization of it?
It's a mature model. See, in the AI, there's a model behind it. You got to train the model, what is right, what is wrong. And what they have done is they have invested so much in getting that model out. They call it a large language model.
Right.
That's what it is. So they have given that to, there are many other vendors are also doing it. So you take this model and build on top of it. And so it's easy for us to actually develop something. Imagine that we all need to do individually all of these models. It's too much expenses.
What are your questions about this large language generative AI still? Because it's working its way. It's not perfect. We know that.
No, you just have to apply it right. You got to test it right. You got to send the prompts correctly. You need lots of test data. You got to work on regulation around it. You also need to be ethical around it. All of these are the things, but it's solvable. It's not that so hard. I'm extremely excited here in our products. We have actually put quite a few and showing people.
Right.
What is, for the advisors, what is the next best action that they need to take? We actually use AI to help that.
Right.
Same thing, the searches that you do. The searches are very boring, that used to be before. Now it's very smart. You can just type it in, whatever you think in a regular English. We'll be able to take that and search and provide the results.
So what do you see as like the perfect complement that this next level AI, if you will be with investment advisors, right? Because the conversation, could it ultimately replace a lot of investment advisory services, or how does it complement them?
See, you have to look at it as, I know people say this is going to replace that and this and this.
And some of it will. Look what the internet has replaced.
Yes, the ATM never replaced the people in the bank. We know that, right?
There's a lot less, though, at Windows.
Yeah, but they do different job.
Fair enough.
Okay, so what's happening in this AI here is going to happen is, I use the word general purpose technology. It's going to be general purpose. It'll be available on everything. So it's not like you're going to apply only on here and here and here. Everything is going to be AI powered, whether it's portfolio construction to tracking, reading the news, telling a good, presenting the client performance report. Everything is going to have something about AI behind it. That's what's going to be the future. Not only in finance, every industry.
So it certainly feels that way from everybody we talk to. How do you think of it as a timeline? Like right now, right? Of course, if you think about online, it's ubiquitous, right? We just assume, we just take it for granted, we use it all the time. It's just such a part of everybody's life, work life, home life, what have you. So when do we get to that level, in your view?
Well, it's happening right now. people are going after it to produce that next productivity in every field. So you're going to see more and more. So I won't say, oh, in 3 years you're going to see it. No. Imagine when the OpenAI and other things were released, you have 5 million users in 2 days. That adoption rate is so high. So people are looking at this technology to find the problem that they really want to solve. And they are going to be very successful when they look at it. Just for the sake of implementing something, you shouldn't do it. Look for the right problem in the right industry, and you apply these. It's available for you to actually make a big impact in what.
What are the questions that have come in the most from the investment advisors that you guys service when it comes to AI?
Well, it's mostly they want to understand.
Is there a lot of what is this and what does it mean?
No, it's mostly they want to understand what's behind it. We call it an explainable AI. See, if you say something, oh, I just figured it out. This is what the answer is. They don't want to believe it. They want to know how do you derive it so that they can believe in it. That's one thing. And there is also regulation behind it. Is it,
Well, that's funny that you say that because that's some of what came up at our conference about this whole idea of, I think it was from Adina Friedman, who's chair and CEO of of NASDAQ. We want to engage with regulators, what the next generation of area you're going to do, how to make it more effective. What do you think has to be the regulatory process around it? I was talking with, Jay Clayton earlier, SEC, and we talked about a lot of things, former chair. But what needs to maybe be the regulatory process around something like that? Does it have to?
Yeah.
Right, we're still figuring it out with stuff that's in the social media space,
So
right?
the biggest thing people in their mind is privacy. It's data privacy. It's very, very important because you train the model and you have that data behind it. And who owns that? That's a big question.
Right.
And also when you do recommendation and things like that, that's like the different fine line. How do you recommend? What is the thing behind it to recommend? Is the suitability of the person is behind the recommendation? All these is going to come. So it needs to be hashed out. That's an open thing. Ethical is another piece.
But is it an SEC thing? Is it a federal regulatory thing?
I don't know which agency technically. Usually different organizations are regulated by different agencies. So they will get in to understand this and they'll implement it. So.
Okay, so lots of AI.
Yes.
What else is interesting? It's been, as you know, a tough week for the crypto world in terms of the SEC moves and suits, if you will, against both Coinbase and Binance.
Yep.
How are you thinking about the crypto world, blockchain, going forward?
Well, is
this the end of it?
No. As a technologist, I want to separate these two things. One is the things that was built on top of it, like crypto and other things, and then the underlying technology.
The blockchain.
The blockchain, the distributed ledger.
Right.
So there is still a lot more potential on the distributed ledger. There's still more things we could do in terms of how we maintain the ledger and other things. That's going to be there. But applying that for what is a different question. I think there's lots of cloud around the crypto and other things that will get ironed out, and it'll take time and it'll progress. But I believe in the distributed ledger technology, and there is going to be use to it. And I think the AI is kind of shadowed that a little bit at this point, but both are great technologies.
I have to say blockchain always made more sense to me in terms of having this ledger where whether it's property you own, what have you. But I do wonder, the idea of it was kind of this purity to it, right? And very direct, cutting out a lot of the middle folks. And I do wonder if that is how you are continuing to think about it going forward, or what do you see as the role going forward within your community?
Well, in the blockchain or in the distributed technology, there is a network of people that actually gives the credibility for that contract, right? So that still needs to happen. It's a consensus-based network.
Right, correct.
And that needs to happen, and that will still be there, and that's how we're thinking.
So what does it do then for the financial industry going forward?
Well, it's going to make things a lot more efficient in how we do things. So instead of having multiple ledgers, imagine if we have multiple ledgers, we have to come together and kind of compare and share and make sure we reconcile and everything.
Right.
If you have a single ledger, all of that goes away, right? So there is a recon efficiency, and also, how a transaction is authenticated, that everybody agrees and it's good to go, rather than each one's trying to figure it out whether my transaction made it or not. So those things will help.
I need some technology to help me with this computer. It's working now. It's working now.
You need an AI on top of it.
I need an AI on top of it. So forgive me as I was a little distracted there. But I do wonder, does kind of the momentum behind blockchain get slowed down because of what we saw out of the SEC and against Coinbase and Binance this week? Or should we, I'm thinking about our audience who's thinking about it as a investment play, should we be separating the two out?
No, they will all come together. I don't think, you're talking about a crypto that's applied or that's on sitting, the technology
right.
Is on it. Yeah. That's always the case. Whenever you have a base underlying framework for technology, different products and other things gets built in. And they need to be regulated on its own thing, not the technology. The technology could be applied for many other things, like the same thing with AI. Where do you apply this AI? So the AI is not bad. How do you apply? And that's when the regulators come and check, make it's done right. It's not the problem with the AI.
What else do you spend your time talking about when it comes to technology?
It's mostly with clients.
Yeah.
I love talking to the clients because you learn more from them, because I love whatever the challenges they put in front of us, because that's how we create new things, solutions for them. So talking to the client, getting feedback is a wonderful thing, and being here in this conference with so many of the clients here, I just love talking to them.
But are there other technologies that they ask you about? Like, we've been so obsessed, obviously, with what we just talked about. I mean, if you think about our conversation, how much we spent on AI, but I think we're all trying to find our way through it and understand the impact. But what else?
There's a lot. I love the payments space, especially in U.S. payments. See, think about it. In the rest of the world has lots of real-time payment, instant payment.
Yeah.
Like, I come from India, and I know India has 1 billion users and 50 billions of this transacted. U.S. is still catching up. We got real-time payments and FedWire that's coming.
Right.
But still, it's not quite there, and that's another interesting thing that we're looking at. And BNY Mellon is on top of it at the clearinghouse RTP protocol. So we are hoping a lot more in that space too.
Yeah, when you talk to the different clients, as you said, you love talking to them, and obviously it's very much focused on technology. What is it that you get? And I've asked this with a lot of other members of the BNY Mellon Pershing teams about the mood and the environment based from what we were kind of a year ago. What are you hearing? What are you seeing?
Listen, they're all after growth, and different verticals of the industry is behaving in a different way, and they all believe that the technology is going to help them actually be productive and enhance their growth. So that's what we see. Actually,
so they want more technology.
That's right. The mood is towards growth anticipation, and they're all working towards it.
Can you find all the workers you need to do what you need to do?
It's an interesting question. We do, but not
How
in
tough
one place.
is it?
It's very hard, but we go across the globe to find the people, we are. It's not an easy. Talent is a very important thing. Talent is not just easy, but we got to get the right talent, work in our culture, and then look towards the growth and improve. So that's a constant. I won't say struggle. It's an interesting challenge.
But there's a demand constantly for you guys.
Yes.
Yeah.
Exactly.
Are you having to pay up for the workers?
Of course.
No, just because you're saying in terms of the workers you need, it's still kind of tight.
Yeah, and especially the young talent coming out from the universities. And you could see here in the conferences, there's so many talents of people who are just going to graduate out here. So that's another pool that we really look forward to.
You're a gem, always. Fun to talk with you. I love what you cover and play within. Good luck. We'll probably talk about AI next year.
Thank you very much. Thank you for having me.
Ram, always good to see you.
Thank you.
Ram Nagapan, he is Chief Information Officer at Pershing, on site here at BNY Mellon Pershing Insight in Orlando. This is Bloomberg.
the session.